Welcome to Non-Consensus Investing. I'm Ram Alawalia, your host and CIO at Lumida Wealth, where we specialize in the craft of alternative investments. At Lumida, we help guide clients through the intricacies of managing wealth so they don't have to shoulder the burden alone. Through this podcast, we draw back the curtain to reveal the strategies employed by the best in the business for their clients so that you too can invest beyond the ordinary.
Hey, how's everyone doing? It's Friday. It's nearly 5 o'clock Eastern time. There's so much happening. I thought I'd do a quick broadcast and share with you thoughts on the Circle IPO, the Trump versus Musk feud, macro and markets. It's really an extraordinary time. I hope you guys are having fun. There's a lot to do. It's pretty exciting from a markets perspective. It's 5 o'clock on a Friday, and here I am talking to people. There's nothing I'd rather be doing now. It's a great time to be in markets and investing, and there's a lot of opportunities that are out there. I wanted to share some thoughts. First off, on Circle IPO, the broader topic here is stablecoins. The world is starting to see the advantages and product market fit around stablecoin. This is something that Scott Bessent, the Treasury Secretary, is very excited about because it advances US dollar hegemony. And also stablecoins attract new sources of capital, which can help the government finance its debt. So stablecoins are an attractive opportunity.
The bigger opportunity is stablecoins, and you're going to see real competition for legacy financial services, right? I mean, so what is a stablecoin? A stablecoin is a bank that's built on chain, so it doesn't have the operating overhead of a legacy bank branch. You can move money quickly, instantly, in a verifiable way without having to walk into a bank branch. So I think this is it's a notable development, even beyond Circle. There's a lot of hype and excitement in stablecoins. You're seeing significant investments in stablecoins. Superstate is one example from Robert Leshner, but there are plenty of others getting backed and funded. And those stablecoins need sources of yield to generate cash flow. Right now, these stablecoins yield 0%. That's why USDC has a very high profit margin. The primary cost of revenue is a revenue split with Coinbase, which is a primary distribution partner. But what's going to happen now is that stablecoins will need to offer attractive yields to attract liquidity from customers. There are stablecoins out there like Ondo, for example, that are investing in T-bills. So these stablecoins essentially tokenizing or wrapping a real world asset or a bond to deliver coupon to a customer. I think what you're going to see is more competition to attract capital and liquidity, because VCs get rewarded when the value of their investments go up and to the right. And so to do that, these stablecoins will have to finance loans with higher yield so that their TVL or the capital and liquidity they have also go up and to the right. By the way, that's a movie we've seen before. It's still early days, but usually the recipe of that movie is you get sloppier underwriting, you get lax rates, bad terms, payment in kind starts to show up, covenant light. And we saw this movie play out maybe most recently in 2015 era, where you had a crop of fintech lenders go public that included players like Lending Club and On Deck, and then players like Upstart and SoFi. All those players since kind of tightened their underwriting model and learned and all the rest. But you could argue that stablecoins are the first realization of what peer-to-peer payments were meant to be and peer-to-peer lending was meant to be from the fintech lending days. It really is. I mean, this is now you have decentralized payments. It's going to be interesting to see how this evolves, though. How can you keep underwriting standards tight in a world where you've got competition amongst stablecoins? It's a land grab. How do I feel about Circle? Like, first off, kudos to Jeremy Allaire, the CEO. He's been at it for quite a while as an entrepreneur. I think starting back with Macro Media, which I think he sold to Adobe. So what a win. Congrats to Raj Date. He's one of my equity investors. He was an investor in Circle as well. kudos, Raj, on what an amazing win. And also the ecosystem for digital assets is getting liquefied. You have a Circle IPO, you're going to have a Kraken IPO. There are more IPOs to come. Maybe you have these security firms that focus on AML, KYC, like TRM Labs or Chainalysis. Those are real businesses. They could go public. So that's going to re-liquefy the ecosystem, especially the venture capital ecosystem. That means valuations will go up, and there are not enough quality deals to get funded. So yeah, it's just some observations around where you are in the cycle. In terms of Circle as a business, I think the reason why this stock went up a lot is because it's attracting crypto capital. The same thing like CoreWeave, like the crypto people involved, it's gonna go up. Now, CoreWeave started as an Ethereum mining operation, so naturally attracted that kind of capital, and it's attracted momentum, and it's got an AI themed story, and it's a leading pole position. It's backed by NVIDIA. It's got all the attributes of a good story. Circle has a lot of that going for it also. There are some differences though, and I think I'm looking at this from an investor hat on now. So Circle will face competition from emerging stablecoins. You can imagine JP Morgan, which has a digital asset team, and BNY Mellon and other banks, which are slower, and JP Morgan's pretty slow, are going to say, hey, why don't I create a stablecoin, offer it to Coinbase, and weave it into their existing technology processes and customer experiences? That's going to happen, right? In the prior admin, Libra wasn't permitted and DM wasn't permitted. They should have been. They're permissible under law, but they were not permitted. That world has changed, right? If you want to compete with China, you advance stablecoins. You allow exporters from China to get paid in US dollar-backed stablecoins. You wean these entrepreneurs off the China ecosystem, and then you give them a visa, move them to the US, and now they're paying American corporate taxes. They bring their know-how and talent, and that's how you compete with China. So stablecoins are strategic. But I think the issue with like Circle is that they're going to face a lot of competition, and they'll have to pay more yield to attract depositors. So from an investment perspective, I'm not that excited about it. It's really a trade, not an investment, right? The funny thing about these IPOs, these are low float IPOs. So that's also driving the prices higher. And it's the same thing you see in digital assets, by the way. So, the more things change, the more things stay the same. So those are some quick thoughts on stable coins. Let me know if you have any questions. Yeah, the IPO market is strong. It's back in a big way. This is something I was talking about in Q4 of last year, to expect a strong IPO market. There are a lot of deals getting done. Animal spirits are cranking. Usually when you see a lot of new offerings and issuance, it means you're late cycle. I'll come back to macro markets on the tail end of this, but capital markets linked players, investment banks that are indexed to IPO offerings should do well. So I think that's one conclusion to take from this, right? The picks and shovels players behind all the IPOs. The other is these stablecoin issuers need sources of yield that are high quality and sustainable. I bet you that these stablecoin issuers are going to wrap private credit funds. Maybe they're in 40 Act vehicles right now and they put them on chain. And that creates liquidity for the private credit fund. It creates new sources of lending. So that's something to watch. Right? I think, private credit underwriting's all over a spectrum. And private credit's played a more important role in lending to Main Street because the banks have pulled back. Banks are doing more conservative corporate credit lending or lending to mortgages and auto where they have collateral and it's a senior secured position and they get good capital treatment. So stable coins could be a mechanism to really grow lending in the markets. Like this is actually a Main Street policy for Scott Bessent. So eventually that won't end well, but that time is not now. I see delinquencies coming down. I see consumer balance sheets are still strong. I still see banks lending with good underwriting criteria. I see consumer finance names exposed to subprime that are still reporting good numbers. So you haven't seen deterioration yet, but like the clock started, right? So you have to watch that. I'm also long consumer finance names, by the way, just to be clear. But it's something you have to watch for. In Q4, maybe we'll be in a different position. We'll have to go see. Look at like Capital One. They're doing well. That's mass market credit card with more near prime exposure, for example. Look at Bread Financial. Look at what they're saying in their earnings calls. They're doing fine. DQs are trending down. But stable coins will create more lending velocity, and there will be an incentive to lend to weaker and weaker credits over time. This is the history of the business cycle. This is how the cycle works. It happens every 8 to 10 years, right? Or even every 4 to 5 years, depending if you're looking at the IPO cycle, right? So keep an eye on that, people. Keep your wits about you, right? By the way, I'm focused on opportunities in Alberta, Canada these days because I'm finding opportunity with strong free cash flow yield. If anyone's in Alberta, Canada, turns out a lot of people I know in Alberta, Canada. So I'm going to spend time there. I'm going to go in September and probably July or August. I'm lining up meetings. So if you know people there, I'd love to talk to them. I'm just building relationships on the ground there. I think these stable coins all need a good source of yield. And I think I can be the picks and shovels player because we invest in private credit, we invest in real assets, and you have to know how to go through the tokenization process to link these two worlds. We know that as well. So I think we're in a pretty good spot to provide a responsible source of yield to these stablecoin issuers who are all competing with one another now. So that's that on stablecoins. Let me know if you have any questions around that. Speaking of IPOs, CoreWeave, looking to hedge somehow to protect the gains. On CoreWeave, I'm going to ride it until the lockup is over. That's one. And then I'll reassess at that point in time. CoreWeave is a real business. They got a nice backlog. It's running up because there's a massive short squeeze. There's an 80% borrow rate on it. I remember seeing this with NVIDIA in Q1 of last year. I've talked to people and they say they're shorting NVIDIA. I said, why? Because it looks like this. It's going up and to the right. I said, it's not a good reason. You're not supposed to do that. You're incinerating your money. If you're going to short anything, you really shouldn't, especially in this market. You got to be nuts to short in this market. I don't know what you're doing if you're shorting this market, but at least wait for the right shoulder or wait for net income deterioration, wait for delinquencies to go up, wait for revenue to decline. What's your rationale? But that's what's happening there. We saw this with Coinbase and Carvana. Coinbase was left for dead in Q1 2023 in the aftermath of FTX. A lot of hedge funds and very sophisticated short sellers were shorting Coinbase and Carvana, and they both had cults of community around them, and that they believed in digital assets, or they liked the Carvana experience. I'm not even sure if that's what it was, but in any case, those were short squeezes, and they started to rally, and then people would continue to short them, and that actually would create fuel for the rally, because anytime you short, you are a future buyer. You've got to cover at some point. So I think that's the phenomenon with CoreWeave. And I think when you have a certain amount of escape velocity, you are in a different category of asset. Like Palantir's got a PEG ratio of 6 times. Does it make sense? No, it doesn't. It is what it is for this kind of market climate. Eventually that'll correct, but not now. So that's my kind of view on CoreWeave. So the volatility side, though, maybe you could sell calls to generate income, not financial advice, but the volatility is high. It's been an incredible outcome for us. That was Lumida's second and fourth deal. Knock on wood, still waiting for liquidity. But we post every deal we've done on lumidadeals.com. We're required to by law, by the way. There's no cherry picking. So we did Brad Jacobs QXO. We did CoreWeave a couple times. And then we have a new deal we just closed on this week. We'll update the website. I can share more later. Unfortunately, I can't preview any deals under U.S. securities laws. I don't know if those laws make much sense, but I can't. So if you're interested in them, definitely fill out the form because there's more things to do. So that's that on the IPO market. But IPO market opening up is animal spirits up, multiple expansion. It also means, Q4 is probably where you have a fully valued market because when you have that much issuance and that much velocity, people get excited and all ginned up, and then they're all in, and then there's no one left to buy. When you're issuing shares in the market, you're creating more supply of shares. So the ideal market is you have a decline in shares, lots of buybacks, and there are a lot of buybacks. There's $1 trillion in buybacks that's happening. By the way, that buyback window is closing on June 16th, so 10 days. That's when the mega cap companies will stop buying back the shares. It's not a surprise that you had a lot of positive market action after the blackout period concluded. There's still a lot of firepower out there. I was going through the stocks of multiple companies today, and these are stocks of businesses that had high share-based compensation, and so I avoided them. And I looked this time around. These are businesses like Yelp and Clear and others, Twilio. I'm not saying go buy those stocks, but I'm just giving you examples. But I noticed that they flipped from share-based compensation to buybacks. So in the last quarter, a lot of company CFOs and boards woke up and said, our shares are too cheap. We got to go buy back stock. That's obviously happening in the healthcare sector where insiders are buying their stock. Not just company shares, but the insiders are just going on the open market and buying that. So that's an interesting observation. I had a chat with a client today, and he was concerned about where the market is, and is there another shoe to drop? Look, you've had a strong jobs report. Initial claims data is fine. It was fine last month. It was strong last month. The mark of a recession is job losses. We don't have that. You have shifts in where consumers are spending. We saw consumers front-loaded their auto sales due to the impact of tariffs. And I talked to my favorite consumer retail analyst, which is my hairdresser. She shops everywhere and talks to her customers all the time. And she was telling me a story about how she knows parents are buying their kids cars ahead of cycle just to avoid tariffs. And we saw in the data today that auto sales dropped. So you are going to have this effect where GDP now is clocking at 4% plus, which is hot and strong. By the way, Q1 was weak, right? It's hot. I think in next quarter, it'll be softer and weak because you did have a pull forward of demand. So you're going to see shifts in where consumers are spending. Auto sales will be weak. I would expect, for example, they front loaded that. I like cruise lines. You prepay for the bookings. Baby boomers are spending. Baby boomers have $60 trillion in wealth. I have a big thesis on follow the baby boomers. They've shifted from saving to consumption, and they want travel and leisure. And I think cruise lines are a great way to express that. I wrote about Norwegian Cruise Lines in our weekend newsletter last week, and Norwegian Cruise Lines done really well. So I think the other names have run up a bit more. They're more expensive. This is more of a catch-up trade idea around Norwegian. I won't pitch you the story here. You can take a look at the newsletter for more. But I guess zooming out, I think consumer discretionary is the area to focus because consumer confidence is coming back. Now the question is where in consumer discretionary you focus, right? You have housing, you have building material supplies, you have auto, you have consumer retail. Even within that, you've got everything from Best Buy to Target to Walmart to Costco to Dollar General to Dollar Tree to Lululemon, which got wrecked 17% today, to Abercrombie and Fitch. So it's a very hard category. Consumer discretionary. You have cruise lines, you have restaurants. If I look across that, I think cruise lines just make a lot of sense, and particularly Norwegian, just given their story. And it's a lot of complexity there, and it'll take 2 minutes. I don't want to waste time around that. And I think some of the restaurants we talked about, like Eat and Loco, good valuation, good EPS growth, good momentum. I think those are a good idea. Housing, the jury's still out. Mortgage rates are high. So I'm not there yet, but I'm watching that category. And if mortgage rates come lower, they could do better. The other interesting category within consumer discretionary is mortgage refi lenders. I think this is a really interesting category. Now, Trump wants to privatize Fannie and Freddie. That would create hundreds of billions of dollars for the U.S. Treasury. That could reduce the debt significantly. The question there is what happens to mortgage rates, right? If you privatize Fannie and Freddie and you have the profit incentive, then might that not lead to higher mortgage rates? Now, what Trump also said is that they would still have a kind of the implied full faith and credit of the U.S. government. Well, if he's talking about it, it's not implied, it's explicit. What does that mean contractual? We don't know. From a policy perspective, you want mortgage rates as low as possible because that is a major burden on the consumer right now, and that would unlock housing. But if they can provide the full faith and credit of the United States government, maybe that can work. We'll see. We'll see. It's not obvious that mortgage rates will come lower if you're privatizing. In fact, they should go higher. So we'll have to see how that plays out. But I think mortgage refinance plays could be interesting, right? If mortgage rates have topped out here, I think they probably have. I think the 10-year's probably topped out. There's a video of the Ray Dalio talking about the implosion of the U.S. debt that went viral. That was the top in rates, peak fear around rates. And rates are coming in and inflation's coming in. You see that with core PCE. If you have a slowdown, inflation will come in. I do think you'll get a whiff of inflation when tariffs hit, and tariffs rating now over the next 3 months. I do think that'll happen. It'll be a one-time effect. That'll play out July, August, September, and then that'll be behind us. So markets will price that in and they'll move past that, and the disinflation trend will continue. So that's one kind of fly in the ointment over the next 3 months or so. We'll see how that plays out. But overall, I think inflation and rates are gonna trend down, right? The real interest rates are very high still. So, that's a sign of strong economic growth, and it's a sign that rates are high too. So I would expect them to come down. That's potentially bullish for mortgage refinance. It's bullish for consumer-linked names and consumer finance. And those are themes I've been focusing on, trying to figure out how to position in consumer discretion. I think those are interesting areas, and finding best of breed players in some of these categories that are oversold. Look at like United and Delta. They're rallying because they were priced for recession a few months ago. Now consumer confidence is increasing. So I messaged to this person. I said, hey, earnings growth is up 12% year over year. Inflation is declining. The baby boomers have $60 trillion in wealth, and they're spending. They're not putting their lives on hold. They're traveling. They're going out to restaurants. That's my lived experience when I'm out and about on the ground. So I don't see this recession in sight. I don't see that. So the time to get worried is when no one's worried. There's still a lot of fear out there, and there's still a lot of people that are just off sides. That position is starting to come back into balance, but we're still not there yet. Europeans and folks in Asia did rotate out of U.S. equities and U.S. fixed income to their home markets. That's created a bid in their home markets. They've done well. But if you want earnings growth, you're going to have to come back to the United States. You can get ASML, I guess. What are you going to buy? What technology exposure are you going to get? There's some European banks which I think are great. European defense story is probably overrated. I had a conversation with a friend who pointed out that these European countries don't want to buy defense equipment from their neighbors. It kind of makes sense if you think about it, right? So, Italy, Germany, and France are going to compete for the manufacturing, and if there's a populist bent, they want to spend locally. So getting defense procurement off the ground is difficult. It's not that easy in Europe. I think that's an overplayed theme. Probably way ahead of expectations is my view there. So those are some thoughts on markets and macro. I think after June 16th and July, August seasonality won't be that great. And but right now, I mean, I can go through a few sectors with you. Let's go sector by sector. I'll tell you what I'm looking at. So share my screen here. So energy. Let's talk about energy briefly. Well, oil is at lows. The lows are likely behind us. And if you have global central banks cutting rates and China's trying to stimulate, oil should do better. Energy should do better. Consumer discretionary, we talked about. Consumer confidence is increasing. You're going to have tax cuts for lower income Americans. Now that will not fully offset the higher cost of tariffs, which will eat into their real income. But that's coming. Communications earning revisions are high. Financials are going to get deregulation and less capital relief. And Bessa needs that because Bessa needs these banks to buy US treasuries to help them lower rates. And we don't see credit risks in the economy. So financials are in a good spot. Maybe regional banks will face competition with stablecoin. That could be an issue, but that's an issue for a later day. That's looking too far ahead in the future. That's not an issue now. So we've gone through 4 categories. These all have good outlooks. Healthcare is dislocated. It's bombed out. Let's take a look at United Health. I talked about this a few weeks ago. That name is up 2.5% today. Look at the free cash flow yield on these assets. I mean, these are attractively priced assets. The free cash flow yield is 9%. These have priced in all sorts of bad news. This is just one example, but there are other assets out there too, like Elevance. You can throw a dart in the healthcare category. Things are cheap. Things have high free cash flow yield. The big question and risk is what the impact to Medicare and Medicaid policy is. That's really the big question. If running an 8% deficit and these politicians want to get reelected, it's hard to see risk there. But that's the number one question. That would impact healthcare. But even then, the free cash flow yields are so high that they've priced in so much risk. And these are not cyclical businesses. These are cyclical businesses. They deserve a higher multiple because of that, right? Healthcare is the one sector of the economy that keeps growing year after year for the last 3 decades as a share of GDP. That's not going to change with more boomers retiring. Then you have technology. So technology is strong year-over-year EPS growth across the hyperscalers, cloud spending revenue up double digit. Now, there are winners and losers in here. I'm not a big fan of Tesla, for example, haven't been. We'll come back to Elon and the Trump feud in a moment. You've got to pick your securities well. I wrote about TSM. I've been pounding the table on TSM. This thing was at 15.6 times forward PE. Now it's above 16. So it's coming back to normal. So it went from cheap and inexpensive to kind of attractively priced. In the summer of 2023, TSM had a 4P of 15.3. That was before the big boom in semiconductors and data center. Let me show you the TSM 4P. Take a look at this. So we're well off the highs and the valuations because they're growing revenue 20% quarter over quarter. So you might think these names are expensive. They're not, versus where their revenue and earnings are today. So don't get scared of heights is the point. Security selection does matter here. I'm not a big fan of Netflix at this valuation, for example, right? Here's Netflix's valuation, right? So 45 times, I'm not a huge fan of that. But, security selection matters. Obviously, there's momentum in these names. I'm not a huge fan of industrials. Industrials are looking expensive to me. That includes defense and the Ubers of the world. We were a big fan of Uber in Q4 of last year. Staples, I'm not a big fan of either. You had a lot of defensive crowded positioning in here. This is the flight to safety trade, right? Like, let's check on Costco. I like to rubberneck Costco. Costco's at 52 times forward P earnings. At least buy BJ's. If you want to own Costco, just own BJ's instead. I think you get better mileage out of that. But I'm not a fan of those. These are defensive sectors, though. These will leak out into these cyclical categories, is my expectation. Real estate should benefit from lower tenure. I'm not a huge fan of the real estate category, by the way. I think there's some opportunities here and there, but and the materials is, you don't have great compounders in that category. They're too volatile for me. But, there could be moves there. So how much market cap is expressed by technology, healthcare, plus financials, plus communications, plus consumer discretionary? A lot. And if those are heading higher, then the market heads higher. I do think you'll get rotations within these categories, though. I think you're going to see more mean reversion and a passing of the baton as certain names get closer to fully priced to other names. So I see a lot of catch-up trades all over the place. Norwegian Cruise Line is one example of that. Loco and restaurants, another example of that. There's just a lot of those opportunities in banks, Capital One, State Street, it's many. It's not isolated. So when I see that, I see uh, more upside ahead. Certainly by year end. Again, the summer, July or September, we'll see how the market responds to the whiff of inflation, and you're going to get some surprise on the macro data. It usually always happens around the summer. Um, so, but that's that on macro and markets. On the Elon Trump saga, wow. I mean, you can't make this stuff up. I mean, this is like reality TV. I mean, you have a reality TV president, right? You've got a social media cabinet. Maybe we shouldn't be surprised. And Trump knows how to play to the cameras. I think he's in the bad news is good news camp, like old news is good news. I don't know. He knows how to hold the attention. Um, Look, what happened? Let's play out the sequence of events. The first event was that Trump did not appoint as a NASA director Elon's preferred director. That's one. That's the point no one's talking about, actually. The NASA director matters because that NASA director can influence spending on SpaceX satellites, launches, mission to Mars, all of that. That's number one. I think that was one of the rifts. Obviously, a dispute around trade was another one, right? Elon has a presence in China, for example. He imports a lot of components offshore, so he's in the pro trade camp. And obviously, there was a big conflict between him and Secretary Besson. So, and then Elon criticized the big beautiful bill. He said, "You can't have a bill that is big and also beautiful. You can have a slim, beautiful bill." I agree with that, by the way. I don't think you can have a big, beautiful bill. I think you can have slim and beautiful bills. The Constitution is pretty slim. If you can put the Constitution in a pocketbook. Cato distributes this. It's like 4 inches by 3 inches. That's the U.S. Constitution. A nation of good laws, right? Montesquieu said, should be where the laws are understood by the public. They're easy to understand, they're accessible, and they're principle based. You shouldn't have a federal register that's convoluted and so complicated and thick and baroque. That's what you have right now, right? So I'm on Elon's side. Like, I feel bad for the guy. He's not American born, and he's done an incredible amount for the United States. Whether you love him or hate him, just be objective. With Tesla and SpaceX and advancing technology, we'll see what happens with Neuralink, enabling people that are blind to have mobility and vision again. What he's doing with the Boring Company, enabling mass transit at scale. We can't keep up with China or France or Japan on that. I mean, that's extraordinary innovation. And trying to cut wasteful spending, I think those are all good objectives. And you've got wartime 8% deficits, and that's not necessary. That's not necessary. So the guy was like camping out and sleeping on the floor in these federal buildings, and trying to cut costs. So he also helped change the trajectory of the election last year. I think there were 3 pivotal moments in the election last year. One was when Trump gave a speech at the Bitcoin conference. Crypto was politically neutral. 3 months later, Fair Shake PAC gets behind Trump, and they won all of their candidates, I think, except one that they fielded, with real dollars. People don't understand how much money is in digital assets. You're seeing it now. You have a stablecoin bill. So that was one. The second was Elon and social media. The third was Joe Rogan. And then also, I think, other things like appealing to the public with the McDonald's stunt, right? And also, candidate Harris was just a bad, flawed candidate. I mean, that's just the case, right? I'm not being political. I'm just trying to call a spade here. So, but Elon bankrolled and put in a lot of capital into these races, and he controls the Twitter algorithm. I was surprised to see Elon react the way he did to Trump by saying, "Hey, the reason the Epstein files weren't released because Trump said that was one." Then he said the truth will come out. He doubled down on that, and he had another. There was another critique he had too. Can you guys remind me what it was? And I mean, these are offenses you can't walk back. I don't think he should have done that. I don't think that was a good move. Then Trump threatened to have an order cutting spending on Elon's affiliated companies as a way to cut spending. And then Steve Bannon came out and said Trump should invoke the Defense Production Act to seize SpaceX assets. Obviously, those two have a big feud. I think that's crazy talk, by the way. I mean, that's worse than China, what China did to Jack Ma, right? I don't think that's the direction our country needs to go in. I think that's bad for markets, bad for capitalism, bad for private property, bad for civil debate, just bad. So, yeah, look, I kind of feel bad for Elon Musk. I think he gave it a shot. He's done a lot for the United States, and he is now on the receiving end of Trump's wrath. Fundamentally, I think longer term, it's good for the United States to have competition. Competition brings out the best in people. That's true at the personal level. It's true in athletics. It's true in academics. It's true in business. It's true in private markets. Competition keeps people honest, and political competition is needed. You need political competition. We don't have political competition, right? You need competition. So I don't know what nature or shape that will look like. I have no idea what this third party will be, but I think that there's a lot of Americans that want to bring in deficit spending that are pro-technology, pro-legal immigration. They want to control borders and fentanyl, and they want a rational policy mix. And Elon, yeah, he's got the platform. And these platforms can shape elections. They can influence them. I don't know if they can determine them, but they can certainly shape them. So, look, I'm not a fan of the stock, but I think the midterms will be competitive, and I think how Elon is treated will influence the campaigns that get funded, and how will Silicon Valley react to all of this. I want to see how that plays out too. But yeah, June 5th might be a notable moment in American history. We'll see. What else? Some other topics here. Canada. So I had a breakfast with a friend from Canada. He grew up in Alberta. As I mentioned, it turns out I have a lot of friends from Alberta, Canada. And he said that Canada, of course, they've had a liberal government for a decade plus under Trudeau. It's really hurt the economy. Their real living standards have not kept pace with the United States, which has gone forward about 20% in real terms versus Canada the last decade. Like, they're suffering. There are real issues there. They're embracing market policies. They're building pipelines east to west. They're freeing up oil and gas. They want to cut deals with Asia and Europe. So I'm actually turning constructive on Canada. There's some good names in that market too. So I changed my mind on Canada. Politicians respond to incentives. They shift. They cater to the median voter, at least in other countries. But so that was a quick thought on Canada. Keep your questions coming, by the way. It's more fun that way. I don't know what you want to focus on, and I've discovered that what I assume people know is not often what people know. So where do you think we see weakness in labor market consumer data? I think you see it in the summer. It seems to happen. It certainly happened the last 2 summers. You have these head fakes and surprises. Has to do with probably the birth death labor model and just shifts in how economies adapt during the summer. Then you have the back to school. Then people think that the economy is weakening when really what's happening is restaurants in Cape Cod and across the coast of Delaware, et cetera, and the Keys are just shutting down, and that employment is refactoring. That's it. So I think summer actually creates a lot of head fakes. I expect in the summer you'll see that again. Are there signs international tourism in the U.S. is down? Airline travel was down, yes. And I talked to a friend who's in Vegas, and yeah, the activity in Vegas is down, but that's backward looking. People were deer in headlights. Seasonal change, the weather's out, sun's out, people get more active again. Backlogs for cruising are significant. They're committed to that. Humans adjust, right? When they feel sad, give them a fresh night of sleep, give them some sunshine, they get back on their feet, especially American consumers. American consumers don't quit. I think international is a good point, though. I think the international market has a different relationship with the United States. I don't know if that'll long-term shift their asset allocation, though, to the earlier point. Like, what are you going to buy? There are some opportunities in Europe, like the European banks. I think the European banks are interesting. Maybe some energy companies like Shell and Total Energies. Okay, what else? What else are you going to buy? I don't know if there's much else. Um, International tourism is a good question. Let's see. The American consumer spending on travel and leisure, though. So, what else? So, covered a lot of ground there. So, exciting time, a lot of transformation, a lot of dynamic events happening. I'd be cautious on being bearish. I'd be cautious on being bearish. Like I think by year end, the S&P will be higher than where it is now. Big picture. Oh, here's a good topic for you. I wanted to close with this: is can you outgrow the debt? That's the question, right? And this is the point that Ray Dalio has been talking about. The U.S. is on this path of fiscal decline and too much debt burden. And can you outgrow it with a big, beautiful bill? You can outgrow the debt, but it's not through fiscal spending. That's not it. What is fiscal spending? Let's break it down. First, the number one, it's interest expense. That's not productive. That's paying for spending we did in the past. So it's not that, right? What's the next big line item? Well, you have entitlements, Social Security, Medicare, Medicaid. That's consumer spending. That's transfer payments from one group to another. In aggregate, it's not an incremental change. It's a shift. Transfer payments. Is it productive? Does it generate higher real growth rate? No. I'm not saying those aren't good things to spend on. I'm not making a value or normative statement. Just saying that that's not productive investment. I mean, it doesn't increase the long-term real rate of growth of the US economy. I'll tell you what will in a moment. I'll give you the punchline in a second. What about defense spending? Is that productive? Well, it's productive in the sense that it prevents war, sure, but it doesn't increase the real return on capital or the long-term trend rate of growth of the economy. What does? Well, deregulation, yes, check. Enabling banks to lend more, yes, that does as well. Any other sources of government spending? Spending on infrastructure and roads, that can help. Yes, if you can encourage more trade and more mobility, that can have a productive investment as long as it's not getting caught up in poor spending, right? I was driving through the JFK airport, and then this billboard saying we're spending $13 billion, whatever the number was, somewhere around that, on renovating JFK. And I was like, why are you proud of that statement? Why are you proud of having spent $13 billion? It's still a dump to renovate JFK. That's not the win. That's not the win. What's the ROI on that investment? It's probably positive, but is it significant? Probably not, because they spent too much. Do they need to renovate it? Sure. Are you getting high-speed rail? Are you getting more like that? That could be productive, for example, right? So, what's productive? What's productive is investments that enable human capital. That's called education. Is the U.S. government doing that? No. Are they good at it? No. State governments, it varies by state. There's more people putting kids in private schools. So I don't think having more fiscal spending drives the one elixir that increases long-term U.S. Growth. And that answer is called productivity growth. That's the number one thing. That is the only magic formula. That's it. When the interstate highway system was built in the 50s and 60s, that drove productivity growth, right? That created interstate trucking, for example. That created more mobility, allowed labor to move from Detroit to where it was more productively utilized. That created productivity growth. The creation of the Freddie Mac mortgage market, which allowed community banks to create liquidity and lend more in their local market. You could lend in your local market, and instead of being constrained by your balance sheet, you could sell your mortgage to Fannie Freddie, and they give you liquidity. So you created a capital market around mortgages. That created productivity growth. Now those wins are behind us, obviously, right? Building airport hubs, containerization. It's like blockchain for transportation. That created productivity growth. Investments in aging and longevity, the green revolution, that created productivity growth. Those are investments that the U.S. government has made that created productivity growth. I don't see that kind of investment now. Do you see it? Let me know if you see it. Put in the comments. I'd love to see it. So how would you want to increase productivity growth? Okay, where is it going to come from? It's going to come from technology and innovation, like AI. That's number one. So how do you encourage it? You get rid of tariffs on semiconductors. You encourage CapEx. You accelerate depreciation and capital expenditures. That's what you do. You encourage small business formation. You encourage entrepreneurship. You don't threaten to take property of people that have created wealth, like Elon Musk. You don't do that. You attract talent. I love the whole golden visa idea from Howard Lutnick. You cherry pick China's best talent. They have more STEM graduates in the United States. You bring them to the United States. If you create a DeepSeek, anyone on the DeepSeek team should get a visa. Here you go. And here's $10 million from SoftBank. That increases productivity growth. So, tariffs don't increase productivity growth, because what productivity growth is about, it's all about cost minimization. It's about how do you create more with less inputs. Remember, economics is a science of allocation of scarce resources. And the price system is what lets businesses, Adam Smith or someone called the invisible hand, is make allocation decisions purely by looking at prices. They're not doing sophisticated mental gymnastics. They're just looking at input costs and output costs. And it turns out if you make decisions based on that, then you are driving productivity growth. You source from better suppliers. Those suppliers have some efficiency. Maybe it's the assembly line. Maybe it's a lower cost labor market. Maybe it's access to highly specialized talent that has know-how in a certain trade craft or tooling. That's how productivity growth is created, right? And that doesn't mean that you don't have tariffs on China. I'm all for that, just to be clear, right? These are complex topics. So, I think we covered a lot of ground. I'm excited about the future productivity growth. It's there. We're seeing it. I think more is coming. I think we're underestimating the pace of productivity growth. And I think Ray Dalio is wrong, because he's not accounting for the productivity growth from technology innovation. And capitalism and private markets will find a way to create productivity. I had a great conversation with my friend Sheila Minot. He's a partner, the founding partner of Better Tomorrow Ventures. We had a nice podcast. He highlighted 3 startups in AI. It's still early days. We're still at the early layer of this, right? When Amazon and online trade, online e-com, it took 10 years after you laid out all the fiber, right? Phase 1 was getting these new websites built up. Then you had a bear market, then it recovered, and then you start to see a real world impact. Even now, you're still seeing shifts to online e-commerce. Like grandmas haven't gone, but COVID got grandma and grandpa on e-com and Amazon. So these trends are still there. So hopefully that was fun. We'll do it again next time. If you're not on the Lumida Ledger, I recommend doing that. I write it every Sunday. It drops at 11 a.m. Eastern time. We talk about our ideas, themes, positioning there. We also call out different curations of all these podcasts and content that's being created. There's a lot of alpha on the podcasts, right? You just got to curate your attention and find the best. So we have people that do this. They just go listen to podcasts. They find the good stuff. 'Cause I need that. I need time. I need return on time. I need to know what to listen to. Is it the BG2 show this week, or is it something else, right? But anyway, I appreciate you spending some time with me. Make it a fantastic weekend. We'll do it again soon. Be well.
Thank you for listening in on the episode. Remember, in the world of investing, the road less traveled often leads to the greatest rewards. I'm Ram Alawalia, your host and Chief Investment Officer at Lumida Wealth, where we specialize in the craft of alternative investments. Invest wisely, stay ahead of the curve, and stay non-consensus.